We all dream of instant wealth, but the path is littered with broken promises. Uncover the most notorious, get-rich-quick schemes and the timeless psychological traps they exploit. The allure of instant wealth is a siren song that has echoed through human history. The promise of escaping the daily grind, of living a life of effortless luxury, of achieving financial freedom overnight. It's a dream that resonates deeply within us all. And for every dream, there are those who are all too eager to sell you a shortcut, a secret formula, a guaranteed path to riches. These are the get-rich-quick schemes, and while their names and methods may evolve with the times, their underlying psychology and their inevitable outcome remain tragically consistent. They are paths littered with broken promises, shattered dreams, and empty bank accounts. Yet, despite countless warnings and historical failures, they continue to lure millions year after year. Today, we're going to dissect the most notorious get-rich-quick schemes, from ancient cons to modern digital traps. We'll expose their deceptive mechanics, reveal the red flags you must recognize, and, most importantly, uncover the timeless psychological vulnerabilities they exploit. This isn't about shaming victims. It's about empowering you with knowledge so you can protect yourself and your loved ones from the seductive, yet ultimately destructive illusion of instant wealth. Prepare to see the dark underbelly of financial fantasy. Let's expose the anatomy of a financial trap. Our journey into the world of financial deception begins with the classic yet perpetually reinvented pyramid scheme. At its core, a pyramid scheme is a fraudulent business model that recruits members by promising payments or services for enrolling others into the scheme, rather than supplying investments or sale of products. The scheme is unsustainable because it relies on an ever-increasing base of new recruits to pay off the earlier investors. Think of it like this. You pay to join, and then you earn money by convincing others to pay to join. The person who recruited you gets a cut, and the person who recruited them gets a cut, and so on, up the pyramid. The vast majority of participants at the bottom of the pyramid inevitably lose their money because there aren't enough new recruits to sustain the payouts. The only people who profit are those at the very top, who got in early. The psychological trap here is the promise of easy money, the social pressure to recruit friends and family, and the illusion of a legitimate business opportunity. The red flags are often a focus on recruitment over product sales, high upfront fees, and promises of unrealistic returns with little effort. History is replete with examples, from the early chain letters to modern variations disguised as investment clubs or cryptocurrency projects. Closely related but distinct is the Ponzi scheme. Named after Charles Ponzi, who famously defrauded investors in the 1920s, this scheme pays returns to earlier investors with funds taken from more recent investors. It relies on a constant flow of new money to maintain the illusion of profitability. Unlike a pyramid scheme, there isn't necessarily a recruitment component for participants. The focus is on attracting new investors. The psychological lure of a Ponzi scheme is the promise of consistently high, often guaranteed returns with little or no risk. The schemer often cultivates an image of exclusivity and financial genius, providing fake account statements and fabricated success stories. The red flags include overly consistent returns regardless of market conditions, a lack of transparency about the investment strategy, and difficulty in withdrawing funds. Bernie Madoff's multi-billion-dollar fraud is the most infamous modern example, demonstrating how even sophisticated investors can be ensnared by the seductive promise of steady, high returns. The scheme inevitably collapses when the flow of new money dries up, or when a large number of investors try to withdraw their funds simultaneously. Then there's the often misunderstood world of multi-level marketing, MLM. While MLMs are legal, many operate on a model that closely resembles a pyramid scheme, with the primary focus being on recruitment rather than product sales. Participants earn money not just from selling products, but also from a percentage of the sales made by the people they recruit into their downline. The psychological appeal of MLMs is the promise of being your own boss, achieving financial independence, and joining a supportive community. Companies often use highly motivational language, emphasizing dreams and aspirations. However, the vast majority of MLM participants, often over 99%, earn very little or even lose money. primarily due to the high costs of purchasing inventory attending conferences and the difficulty of recruiting enough people to build a profitable downline. The red flags include high pressure to recruit, emphasis on lifestyle over product quality, and a compensation plan that heavily favors recruitment bonuses over actual product sales. While some individuals may succeed, the structure often makes it incredibly difficult for the average participant to turn a profit, leading to significant financial and emotional distress. Not all get-rich-quick schemes are outright frauds. Some are driven by collective delusion and irrational exuberance, leading to speculative bubbles. These occur when the price of an asset rises rapidly and unsustainably, driven by speculation rather than intrinsic value. Everyone rushes in, fearing they'll miss out on easy money, pushing prices even higher until the bubble inevitably bursts. The most famous historical example is Tulip Mania in 17th century Netherlands, where tulip bulb prices soared to astronomical levels before crashing, bankrupting thousands. More recently, we've seen the dot-com bubble of the late 1990s, where internet company stocks with no profits traded at insane valuations, and the 2008 housing bubble now, where real estate prices became detached from economic fundamentals. The psychological trap here is FOMO, fear of missing out, and the herd mentality. People see others getting rich quickly and believe they can too, ignoring fundamental valuation principles. The red flags are rapidly escalating prices, widespread public participation, and a narrative that this time it's different. When the bubble bursts, the vast majority of latecomers are left holding worthless assets. In the digital age, get-rich-quick schemes have found new fertile ground in unrealistic online ventures and digital scams. These can range from fake cryptocurrency mining operations, dubious e-commerce dropshipping courses promising millions with no effort, to forex trading robots that guarantee daily profits. The internet provides anonymity and a global reach, making it easier for scammers to find victims. These schemes often leverage sophisticated marketing, testimonials from paid actors, and the promise of passive income through automated systems. The psychological appeal is the idea of making money from home with minimal skill or effort. The red flags include promises of guaranteed high returns, pressure to invest quickly, vague explanations of how the money is generated, and a lack of verifiable information about the people behind the scheme. Many also involve complex, jargon-filled explanations designed to confuse and intimidate potential victims. The ease of setting up fake online presences makes these particularly dangerous, as they can disappear overnight, leaving no trace. One of the most insidious forms of get-rich-quick schemes is affinity fraud. This type of scam targets members of identifiable groups such as religious communities, ethnic groups, professional organizations, or even social clubs. The fraudsters are often members of the group themselves, or they pretend to be, leveraging the trust and camaraderie that exists within the community. The psychological power of affinity fraud lies in the breakdown of critical thinking. Because the scammer is part of the trusted group, victims are less likely to question the legitimacy of the investment opportunity. They rely on the endorsement of their peers or community leaders, who may themselves be unwitting victims. The red flags are often a focus on personal relationships over due diligence, pressure to keep the investment a secret, and promises of exclusive opportunities only available to members of the group. When these schemes collapse, they don't just cause financial ruin, they shatter trust within communities, leading to deep emotional and social damage. The betrayal by someone within one's own trusted circle is often far more devastating than the financial loss. So, while the specific manifestations of get-rich-quick schemes may change, the underlying psychological traps remain constant. The allure of effortless wealth, the fear of missing out, the desire for belonging, and the tendency to trust those who appear to be like us. From pyramid schemes to Ponzi schemes, MLM pitfalls, speculative bubbles, online scams, and affinity fraud, they all prey on our deepest financial hopes and fears. Understanding these mechanisms isn't about becoming cynical, it's about becoming financially literate and resilient. It's about recognizing that true wealth is built through consistent effort, sound principles, and a healthy skepticism towards anything that promises too much, too soon, with too little risk. The path to genuine financial freedom is rarely a shortcut. It's a marathon, not a sprint. Are you ready to build your wealth on solid ground rather than chasing a mirage?